U.S.'s new tariff.
Markets are falling sharply.
Markets have once again opened with major losses.
If you're looking for where to put your money in 2025, you landed in the right place. The market is wild right now. Tariffs, volatility, tax shakeups, you name it. But don't worry, today I'm breaking down the top 5 things you should seriously consider investing in right now. Based on the latest expert insights and data, these picks are designed to help you balance growth and safety no matter what this unpredictable economy throws at it. Let's jump right in. At number 1, it's the technology sector, specifically AI and wide moat companies like Apple, Alphabet, Amazon, Microsoft, and Nvidia. Now, I know tech stocks had a rough start this year. In fact, the S&P 500 dropped nearly 5% on April 3rd, their worst day since 2020. That wiped out over $2.4 trillion in market value in just one day. But here's where the opportunity comes in. Wide moat tech stocks are currently trading at a 7% discount to their fair value. That's the most attractive pricing we've seen since fall of 2023, according to Morningstar's Q2 2025 outlook. Wide moat just means companies with durable competitive advantages. Think brand loyalty, network effects, or proprietary tech. AI is expected to continue driving a productive boom, and companies that are leaders in this space will likely dominate in the years to come. Morgan Stanley pointed out that after major AI innovations, we've historically seen major spikes in stock performance. In fact, S&P 500 surged 33% in 1997, riding on the back of tech productivity breakthroughs. So, while companies like Nvidia and Apple are facing higher costs this year due to the new Trump-era tariffs on Chinese components, the long-term upside is still there. And some chip makers are actually getting tariff exemptions, meaning they're not as exposed as people might think. If you're thinking long term and you can stomach a little bit of volatility, this sector is a must watch. And if you're still skeptical, consider this. AI is being adopted across every major industry: healthcare, finance, logistics, retail, you name it. The impact of AI will be exponential. So by investing in companies building these tools, you're investing in the infrastructure of the future economy. The other thing to remember about tech is that innovation doesn't slow down just because the market does. The companies that invest in R&D during tough times are the ones that explode during recovery. Think about how Amazon expanded during the dot-com crash, or how Apple doubled down on product innovation during the 2008 recession. The biggest wins come when you invest before the rebound. Now, let's move on to number 2, the healthcare sector. This is a classic defensive play during economic downturns. People still need medicine, doctor visits, and surgeries no matter what's happening in the stock market. That makes healthcare more resilient in a shaky economy. What's interesting now is that healthcare isn't just about big pharmaceutical companies anymore. The real growth is in healthcare technology. We're talking about innovation and telemedicine, wearable health devices, biotech, AI-assisted diagnostics, and robotic surgeries. Think of companies like Teladoc, Moderna, and smaller biotech firms innovating around CRISPR and genomics. These aren't just buzzwords, they're the future of treatment, diagnosis, and patient monitoring. Forbes and US News both point to healthcare tech as one of the top performing sectors for 2025. And here's another point worth noting. Healthcare stocks have seen only slight decreases recently, especially compared to sectors like consumer discretionary, which took a much harder hit. That makes healthcare even more attractive right now. Also, because healthcare is largely domestic, it's insulated from all the geopolitical tension and tariff fights that are affecting other industries. So while tech might offer higher upside, healthcare offers balance, resilience, and some exciting innovations. Think of this as your portfolio seatbelt. It keeps things steady when everything else is shaky. And if you're someone who values social impact, healthcare offers that too. You're investing in better outcomes for aging populations, for new treatments, and for technology that improves lives. And let's not forget, as life expectancy increases globally, the demand for healthcare will only go up. This is not a short-term play, it's a demographic-backed long-term megatrend. All right, coming in number 3 is a classic, gold. When the economy gets weird, investors go back to basics, and gold is the ultimate safe haven. According to JPMorgan, gold could hit $3,000 an ounce by the end of 2025. That already happened. That's a big deal. The main drivers behind this forecast are constrained global supply and bullish macroeconomic factors. In other words, supply is tight, demand is growing, and the outlook for the currencies and global stability isn't exactly great. In 2024, gold already performed really well, especially when the market started responding to inflation fears and the early stages of these new tariffs. Now, in 2025, it's set up for another strong year. What makes gold particularly appealing is that it's not just a hedge against market volatility, it's also a hedge against inflation and currency devaluation. With central banks still trying to juggle inflation and growth, gold is one of the few assets that give investors peace of mind. It's also great for portfolio diversification. If all your investments are in stocks, you're exposed to the same risk, but gold is zigzags when everything else zags. So adding a slice of gold to your portfolio can reduce overall risk while giving you upside in tough times. Plus, there are more ways to invest in gold than ever before. You can buy physical gold, invest in gold ETFs, or even consider gold mining stocks if you want leverage bet on the price of gold. And for those who want exposure without physical storage, digital gold options have become more popular and accessible through apps like Robinhood, SoFi, and others. Okay, number 4 on our list, municipal bonds. Now I know what you're thinking, bonds? Really? But hear me out. Municipal bonds, or munis, are having a moment in 2025. These are issued by the state and local governments to fund public projects, and they offer tax-free interest income. That's right, tax-free. That alone makes them incredibly attractive if you're in a higher tax bracket. According to Forbes and Bankrate, municipal bonds are among the safest investments this year. Yields are near 15-year highs, which means the returns you're getting are some of the best we've seen in over a decade. Plus, with the uncertainty surrounding federal tax policies due to all the new tariffs and potential government spending increases, muni bonds will give you a built-in tax hedge. Let's talk risk. Municipal bonds are typically lower risk than corporate bonds and much lower than stocks. And because their performance doesn't correlate closely with the equity market, they act as a buffer during downturns. When stocks go down, munis usually hold steady. If you're someone looking for reliable, stable, and tax-efficient income, this one's for you, especially retirees or anyone building a low volatility income portfolio. There are also many different types of muni bonds, from general obligation to revenue bonds. So you can tailor your exposure to your own risk profile. And if you're not sure where to start, there are excellent muni bond ETFs that diversify across many states and projects. Look into names like VTEB or MUB if you're interested in dipping your toes in. Now, let's move to number 5, small cap value stocks. This is the sleeper pick of the year, according to Morningstar. Small cap value stocks are currently trading 18% discount to their fair value. That's a massive deal. These are companies that are fundamentally strong, but temporarily out of favor. Historically, small caps tend to outperform large caps during periods of economic recovery, and we may be heading into just that, depending on how the trade and tariff landscape plays out. Russell Investment also sees a lot of upside here, especially with discussion around tax cuts and deregulation that tend to favor small domestic businesses. These stocks are more volatile, no doubt about it, but with high risk often comes high reward. That said, you do need to be more hands-on with small cap stocks. Not every name in the sector is going to be a winner, so active management and strong research are key. You're essentially buying into businesses that have more room to grow, are less covered by analysts, and have more potential for surprise upside. If you're the type of investor who could tolerate some swings and is looking for higher return potential, you should absolutely consider small cap value stocks as part of your portfolio. So if you want to stay ahead of the curve, protect your wealth, and grow in 2025 and beyond, hit that subscribe button and turn on notifications. Because trust me, you don't want to miss what's coming next.